I think we could have a sideways market for several years. It may not be the boom bust where we get these peaks, but it could just be a choppy range. And that range could be 4,500 on the S&P to 3,500 on the S&P, and not make a new high or new low for quite a while.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with portfolio manager and hedge fund expert Thomas Thornton. If you haven't yet watched part 1 of this discussion with Tom, in which he explains why he thinks this bear market is by no means over and that financial asset prices may be stuck in a sideways action for the next few years, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Tom also shares his outlook on which assets he thinks will perform best through the rough ride he sees ahead for the rest of this year, so be sure to stick around for those. Okay, let's get started watching part 2 of our interview with Thomas Thornton. Companies really begin to bring down their guidance maybe in the next quarter or two, that could be another trigger for a big leg down. But you know, how deep do you think this could go, and what path do you think we're going to take to get there?
I think the best case scenario is that we go back and test the lows that we had recently. We could go lower. You know, there's been a lot of technical stuff around 3,500, 3,600. I think the 200 moving weekly averages around there. And that's a bit where we topped out right before the pandemic. So there's a lot of support and money around that level there that I think is important. A lot of strategists have looked at that level as their price targets. Strategists that I think are really, you know, quite good. You know, we could go down to 3,200, 3,000. Depends really if those mega cap names start to really show underperformance. And that, again, it's really hard to get those to show underperformance because they have a lot of levers they can pull. But again, we've seen Meta, Facebook, you know, get absolutely mauled, and Amazon, Alphabet, those have been hit pretty hard as well in the last year. You know, Apple, not so much. Amazon, well, you know, Apple, I mean, Apple is my favorite company in the world. I think it's overvalued at this level here. But right now, I think those are the levels I'm watching. I think it's going to be important to watch what happens in September, ahead of October. We have elections. You know, the market doesn't tend to do well in the midterm elections. Once the elections are over and we kind of figure out who's in, then it proceeds to, you know, move up. But it could be like 2000, where we had a lot of political instability combined with earnings guidance coming down big time. So those could be the catalyst. I mean, look, there's always the black swan catalyst in China, Taiwan. There's stuff in Russia, Ukraine, Iran. I mean, North Korea, throw them in. If one of their missiles, you know, misfires and hits Japan, I mean, anything could happen that could just sink this market pretty quickly. So it's hard right now to say, oh, we're just going to go lower because the Fed. A lot of things have to happen. But, you know, again, I have those black swan type thoughts out there that I'm watching. Really, sure. Just earnings are going to come down. The Fed's going to keep going, and inflation will probably level off and maybe not go down enough as much as the Fed wants.
Okay. All right. So where are we right now? The day we're talking, I think the S&P is what, 4,100 something ish.
We are, I can tell you, let me just move you here. We are at 4130.
All right.
Down 2 basis points.
Okay.
So I'm not missing much in the market today.
All right.
It's good. I like I like quiet Mondays. We haven't really had quiet days in the market, and it's summer. People are going on vacation. August is sort of a doldrums type month, but there's a lot of action happening, a lot of economic data coming out. And then you have Jackson Hole later in the month, which everybody's going to expect the Fed to say something dovish. They may not if the market keeps going up.
Yeah, well, it sounds like I would say more than most of the folks I talk to, you seem to think that the Fed is gonna hike more aggressively for longer. There's a spectrum of people that I talk to, and there's certainly some that say, "Oh, no way," the Fed, for reasons X, Y, or Z, can't tighten much more. And there's some people that are calling for a pivot by Q3 or even before the end of August. So we'll see. But it seems like you think the Fed is going to stay the course for longer, especially if the markets continue going up. Especially if inflation or unemployment isn't moving too far too fast. You feel like the Fed's got a lot more air cover to tighten more than maybe most people are giving it credit for.
Look, I mean, maybe this is the entire soft landing where the market goes up, rates go lower on the 10-year, 30-year, and the Fed's able to continue to raise rates. But again, there's a huge balance sheet out there that the Fed has, and they're going to continue to tighten that, and they may even increase it at the next couple of meetings, which I think would be appropriate. It would definitely put a little sting into the market. And, again, it's going to come down to earnings. And, remember, the Fed actions typically have a lag effect of 3 months minimum, maybe 6 months. So it could start to happen around October, right around earnings, right around all. I mean, it's going to be an interesting fall, in my opinion. And one that, again, it's just going to stay on the tactical trading year that we've been doing.
All right, so back to that sort of tactical approach. Are there particular assets for this type of market that you like and tend to prefer to have in your portfolio? And there's certain type of assets that you really are eschewing right now, given your macro outlook?
Well, one of the things that you want to do when you are buying dips is you want to buy what's going to move. And what's the easy ones? When markets go down, I always tell people upgrade your quality. And you can buy Apple, you can buy Microsoft, you can buy a lot of the stuff that you can sleep at night with, and diversify around a lot of different sectors. I don't really like banks right here. Energy, I'd like to see it go down a little bit more as far as finding a place to buy. But those are places that have been where the consumer and retail have bought. It's been a little tricky in retail, the retail names with Walmart guiding down. But look at it, it just came right back up. And I was pretty amazed that the entire move down, they recaptured it. And that to me is telling me the sentiment in the market is overly optimistic right now. So yeah, I go to the handful of names of where I want to buy. And right now, I think those handful of names, the tech names, the mega cap names, are getting a little bit ahead of themselves. And so I'm shorting some of them right now.
All right. And is your portfolio, I'll let you comment. Is it appropriate for sort of the average investor as a vehicle, or is this more sort of, a portion that the average investor might want to put some money in the portfolio that you're doing? Because it sounds like yours is more of a trading vehicle where you're kind of in and out based upon shorter term conditions.
Again, I have, a couple fundamental longer term ideas in there. Level 1 CFA, I got through. Then I got hired at a hedge fund, and that was that. I like some value names, names that I think make a lot of sense. I was a media trader when I was at my fund years back, and I like Paramount. Trades at 4 times earnings, current earnings, 12 times next year's earnings. every analyst on the street has downgraded it. It's paying 4% in yield. It's $16 billion market cap. And, they're valuing all these media companies as streaming companies. And Paramount has the best movie of the year, or the biggest box office movie of the summer, Top Gun. They have a great catalog. So I like that. But going back to is what's appropriate. I think people can look at my stuff. The average investor, I'm not for everyone. But I find ideas on the long and short side. And a lot more people are gravitating towards that, especially in a bear market. And they want to see when I get long. Some people I know move 100% to cash when I'm super bearish. And when I turn into a bull, they buy everything I buy.
All right. Well, great, fantastic, and thanks for the Paramount pick there too. I know some folks will go check that out right now. So you talked about sentiment real briefly. So I'm going to wrap things up here, but a couple of last quick questions for you. One is, so I've heard from a number of people who are longtime capital managers who say, look, a bear market sort of doesn't really end until nobody wants to touch a stock again, until people's confidence in the market, just their tolerance for the markets is just completely destroyed. And I think I heard you say that you don't think we're seeing that yet. In fact, maybe we're seeing the market being a little too optimistic here, given the current conditions. What's your thought on that, and what are the key sentiment indicators that you look at?
Well, one thing, you can look at inflows. Inflows this year have continued to be really pretty strong for equities. We haven't seen outflows. You look at ARC funds; they still are getting inflows. Bad days, they get some outflows, but everybody's wanting to catch the bottom. And going back to other periods, bottoms were really scary. I mean, March of 2020 was a really scary bottom. You had so much uncertainty. You didn't know what was going to happen. I think it was March of 2002 when the NASDAQ broke. Yes. 2003. When it held. And I think that was around the Afghanistan, Iraq war was starting. And the market bottomed, and it felt comfort catching up at that place. So it felt very uncomfortable, but that was a capitulation bottom for sure. So we haven't seen a real capitulation in equities. We have maybe in bonds, but you got to watch flows. I track all the market sentiment indicators, and when I was at my fund, one of my tasks was to talk to all of the people that compiled all their sentiment stuff. So I had access to everyone, and I know a bit of the secret sauce, what they look at. There's a few that I really like. I like Investors Intelligence, newsletter writer surveys. It lags about 1 week, but it tends to get the longer term picture pretty good, and it's in a bear market formation right now. I look at the daily sentiment index, which I put charts on I get all the data downloaded and I put them on my site. And you can see basically traders are asked, are you bullish or bearish? And it's a percentage. And going back to last December, we had readings over 90% bulls. And that was concerning to me. And now this year, we've had several that have been under 10%. And we're about 47% right now. We're right in that midpoint. And when we get above 50%, that's telling me the majority of people are now turning bullish. And it's not necessarily, one thing about sentiment that people should realize, sentiment is a condition. It can and might stay overly bullish or overly bearish for a longer period of time. I like looking at definitely some of the sentiment indicators at that 50% level. That works well for me. But you need a trigger, and I use other technical indicators, exhaustion signals from Tom DeMark. Been using the signals for over 20 years. I put it on stocks, bonds, currencies, and commodities. They tend to do well. I have some on economic reports. I have them on the CPI reports. And oddly enough, on those monthly CPI reports, going back 100 years, the DeMark exhaustion signals really did a great job at calling the top in the CPI and the bottoms, and unemployment. So I post those on Twitter all the time, and people think it's crazy, and it might be, but the indicators actually really have been great. So I keep looking at it. I also tracked, and I've done it on 2 presidential elections. I take the raw data off some of the polling, and I'll code it into my Bloomberg terminal and overlay the DeMark indicators on there. And I can tell you that when ahead of the Trump-Clinton election, I was telling people, you're not going to believe this, but I think my indicators are telling me that Trump has momentum going into the election, and Hillary has just lost a lot of momentum. And it is just uncanny. I'm apolitical, happily that way, but it just sometimes kind of crazy stuff like that happens. So maybe it's more of a sentiment thing as well.
All right, but it sounds like you say, look, when you find an indicator that works statistically, you're going to listen to it.
That's right.
All right, so last question I want to ask you here is just your general, any other parting counsel that you have for the average individual investor, which is pretty much the viewer of this channel, who is trying to navigate this very complicated market, and not trying to avoid becoming roadkill to its ups and downs, but also hopefully positioning to grow their wealth over time here. So I'll ask that question, but real quick, I believe from what you have told us in this hour interview here that we are in kind of a different paradigm now for investors, where you could kind of set it and forget it. You could just buy a sector ETF and ride it, for much of the past 12 years or so, and do just fine. We're now, I think, in an era where active management becomes much more important than passive management. You've got to do your detective work. You've got to watch your positions closely, and determine what you want to do if they get too overvalued or undervalued. The set it and forget it days don't really apply in this market. I think that's the case, and I think it sounds like you may agree given what you said, but I want to give you a chance to opine on that in any way you like.
Yeah, I think that's very true. And again, I think we could have a sideways market for several years. It may not be the boom bust where we get these peaks, but it could just be a choppy range. And that range could be 4,500 on the S&P to 3,500 on the S&P, and not make a new high or new low for quite a while.
But you could make money on the ups and the downs, right?
I think people need, I don't think it's a set it and forget it type market. And that type of mentality is going to wear thin when people start looking at their portfolios, and they're going to say, I haven't made money in 2 years. I've got to rethink this or do something else. Now, some of the really basic things that I tell people: make your sizing, as I've mentioned a few times, keep your sizing appropriate, so you can sleep at night. You don't go nuts and buy something or trade options or get crazy with margin. Those are the quick, easy ways to lose all you have and blow yourself up. That's, there's get rich schemes don't work. And I think that's really, really important. Also, don't be afraid to take losses. Now, we're coming into the end of the year, and a lot of people have losses in their portfolios, and you can do a lot of tax loss harvesting. Don't be afraid to do that. because those losses can actually work well for you against gains in the future, or gains that you already have. So that's really important. And the other thing is, don't be afraid to sell too early. Don't be afraid to be wrong. This is a market that is imperfect, and I'll make a bunch of different mistakes. If my sizing's right, it's a small nick, the bleeding will stop and I can carry forward. And then I think it's just really important for people just to, if you start getting some gains, take some off. Don't keep adding to those. Take some off, lock in some gains, let the rest of it run if it's going to run. But don't look back either. I mean, I can look back on, the billions of shares I've traded in my life and say, oh God, I wish I had that one. But it just makes no sense. Every day is a new day for me. I try to keep people in the game, and that's, I think, the main thing. This market will get easier. I just don't know when, and it's just going to be something that you need to keep an eye on. The other thing that I'll say, and really the best thing of market sentiment that the average person could just watch, is watch the newspapers. I mean, I live on the East Coast, and I watch the New York Post, and they always have, these gory looking traders looking like this when the markets, go down. Those are good times to buy. Those are good times when the market, the newspapers and the TV, you see the nightly news or CNN or whatever, they lead with, this is a horror show of the markets. CNBC has their markets in turmoil. They're showing you that that's actually the time to start putting money to get to work. It's just a great sentiment read. You can also watch CNBC as well. I don't, but when they're overly bullish on things, you can look at it always when they're, talking about crypto, and they have these people come on with these great price targets like, oh, it's going to 1 million. No, it's not tomorrow. And so I think you see that. Like the last one I'll say was the meme stocks. I mean, I had my daughter, who was in college, call me and say, Dad, what's up with this GME? I was like, this is a top. And it topped that day, and it was on every news channel.
The shoe shine
It was
boy
like
moment.
a motto. Yeah. So I think that those are little things you can just watch. And if you see your neighbors buying new cars because they got rich on Bitcoin or some stock or the market, that's probably not a great sign to say, I want to do the same thing.
All right. Well, look, that's perfect words of wisdom from a man who's been very successful investing in the markets for decades. So I really appreciate you sharing those pearls. Don't be afraid to do tax loss harvesting. Don't be afraid to sell too early or to take gains early on. I think both of those limit your downside risk. And even if you're selling a little bit too early, you're still locking in a gain, right? You're confirming that you're going to get that gain. And then sentiment as an indicator. And one I'd just like to get your feedback on this. We talk on this channel a fair amount when experts like you make the point, which is, as individual investors, oftentimes our biggest enemy in the trading game is our own human emotions. And they tend to compel us to make the wrong decision right at the wrong period of time, right? You just gave kind of a couple of good examples there, but I think in the type of market that you think might be unfold over the next couple of years, where we're kind of stuck in this trading range, emotions can be a really dangerous part of the mix, because as things begin to approach the upward bound, then the narrative kicks in of, okay, this is it. This is when we're going to break through now. This is the new era, for the new bull run, and everybody jumps in, and then it starts heading down towards the lower band, right? So, and then everybody gets despondent and they hop out right as it's bottoming. So, our human nature is almost kind of, anti-wired for the type of environment that you see coming here, which is why I think people really need to have a trade or an investing plan that is based on, hey, under these conditions, this is where I'm going to buy. Under these conditions, this is where I'm going to sell. Ideally, work with a professional, either subscribing to somebody like you or working with a professional financial advisor who can help kind of ground any trading decisions based on, okay, so what does the plan say, as opposed to just letting someone's emotions say, I need to buy or I need to sell right now. I see you nodding a little bit as I'm saying this, but what's your reaction there?
Well, one thing I will say, I've actually had a couple of trading psychologists help me, and I had one named Ari Kev, Denise Scholl, who's prominent on Twitter. Chatted with her; she's one of my favorite people. Ari's gone, and I worked with him. He was a trading psychologist at SAC Capital, or SAC, which is it's now 0.72 with Steve Cohen.
Super highly successful Steve Cohen.
Yeah, I mean, the best trader in the world. But I use my emotions more. I want to know when I'm anxious. I want to know when I'm overconfident. I want to know when how I'm feeling. And I write down everything in my book right here. Sloppy writing, but I do every day, and I write down, how I'm feeling, why I did something, and I try to understand that. I was furious at myself on Friday. I could barely talk. I turned the computers off and everything was fine. But I think you should use your emotions and know if you're like, oh, I want to get in there. If it's FOMO, maybe to go a little smaller than your normal size. Just because sometimes you see that and you can catch yourself. So use your emotion. Don't suppress it. I mean, that's the worst thing in the world, because sometimes it'll be the best thing, especially if the markets are getting killed and your stuff is going down. You want to recognize that, and if you see it with others on TV, or you see it in the newspapers or the news or whatever, you want to recognize that and say, everyone else is panicking. This is the time where, if I'm down, I'll take some losses and upgrade my quality into better names. They may not go up as fast, but they're gonna go up. So buy better quality. So use your emotions. Don't suppress them.
All right, but it sounds almost, don't put words in your mouth, but it sounds like you're saying you use them almost as like a contraindicator. Like I'm feeling myself getting emotionally moved to do X, and I need to step back and say, hey, is that maybe a sign that it might be time to actually do something quite different? Yeah,
one thing I always get people to say, they'll ask me, hey, I've got a good gain in XYZ, should I sell it? I'm either going to be right or wrong. I tend to tell, when I start to think that myself, I'll sell half. I'll just be like, okay, I have reasoning why I want to sell it. I have reasoning why I want to hold it. I'll be half right, half wrong. We'll see where it goes, but I'll lock in something. Just makes me, that's just
even
just
if I'm asking the question, that's a sign to sell at least half.
Yeah, take some off. What's gonna hurt? If it goes up tomorrow, you're still long. If it goes down, you locked in some profits. So that's a little bit of a thing that I'll do. I'll just write it down and say, take half off. No problem.
All right, folks.
Well, don't look back. Don't look back. Just take some off and say, okay, could have gone down, but it went up. I'm still long, still making money. It's an imperfect world. The stock market, the bond market, all markets. It's imperfect.
All right. Well, I really appreciate you sharing that. And folks, that's an inside trading tip right there from, again, one of the more successful investors alive today. All right. Well, Tom, look, for folks that have really enjoyed getting to know you through this interview and would like to learn more about you and your work, where should they go?
My site it's called Hedge Fund Telemetry. And you can also find me on Twitter at Tommy Thornton. So, reach out if you watch this today. You can reach out to me on Twitter, and I'll give you the special discount code. So if you've watched me all the way through this, you deserve a break on my annual rate. So definitely thank you. Thank you for having me. Great questions. It's been really fun. Enjoyed it.
Thanks, Tom. Well, it's been a pleasure. I know we'd love to have you back on in the future already. So I'm gonna plant that seed with you right now.
Excellent.
When we edit this, we'll put up the links to your website and to your Twitter handle so folks can go there. Special plug for your Twitter. I follow that religiously. You put up a lot of great data and charts there. Okay, so real quick, folks. You may remember last week we just debuted a new free resource, which is my summarization, my written summarizations of my key takeaways from this conversation. So if you want to read my notes from this conversation here with Tom, just go to wealthion.com/Adams notes, and you can read them there for free. As always, we recommend that folks work under the supervision of a professional financial advisors in trading this type of market. And Tom and I just gave, I think, a bazillion reasons why that given his market outlook, that makes even more sense these days. If you want to talk to one of the firms that we recommend, just go to wealthion.com, fill out the short form there. We'll set up a free consultation with them. Doesn't cost you anything, no commitment to work with them. They just do that as a public service. And if you'd like to see Tom come back on this program and see us get other guests of his high level of caliber, do us a favor and support this channel by hitting the like button and then clicking on the red subscribe button below. Tom, again, can't thank you enough for coming on. Look forward to having you back on this program later this year.
Thanks, Adam. It was great.